The Central Bank of New Zealand held rates amidst uneven growth, and this decision indicates a clear tightening bias. Many were expecting this decision. I have Cameron Bagrie, Chief Economist from ANZ in Wellington, on the line. So Cameron, do you think this is the right strategy to take, and do you think Graham Wheeler will raise the official cash rate as early as January?
Yeah, look, I think it's pretty hard to quibble with the spirit of the decision or what they're communicating here. Look, the economy's looking a little bit stronger under the bonnet. It's not one-way traffic. We've still got pockets of weakness outside of the Auckland and the Canterbury regions across New Zealand. But I guess if they go back and have a look at where New Zealand sat 6 months ago, there was a reasonably symmetrical risk profile for the economy. There was some upside risks, there was some downside risks. 6 months on, a lot of those downside risks have not completely been eliminated, but I guess they've subsided. And I guess with more upside risk in the pipeline for New Zealand, I think the economy, that transfers into an upwards risk profile for interest rates. And I guess we've got to remember that we've got the official cash rate at 2.5%. So any thought of the Reserve Bank lifting interest rates is hardly jumping on the brake. It's just more a turn towards taking the foot off the accelerator. At this juncture, we expect the Reserve Bank to be lifting interest rates 2014, probably around March as opposed to January.
And how has the New Zealand dollar been trading before and after the decision?
Well, it was wobbling around before. The New Zealand dollar tends to be the two-bit player at the international roulette table. So what tends to happen with the greenback, the American dollar tends to hold sway from night to night. What we've seen over the past, 3 months has been a clearer trend up for the Kiwi Aussie dollar, based on New Zealand's economic outperformance, and it looks like the Reserve Bank is going to be lifting interest rates in the next 12 months. Conversely, the RBA is going to be cutting interest rates after the decision. We've seen the Kiwi dollar up at 30 to 40 points. Kiwi Aussie dollars popped through 87 cents. It still looks like it's headed a little bit further up. Tonight, I think the US dollar story will start to hold sway. The domestic story will subside in relevance apart from the Kiwi Aussie cross.
And of course, looking ahead, what type of actions are you expecting to see from the central bank this year, and what type of events will you be keeping an eye out for over the coming weeks that you think will have an impact on the markets? Well,
I guess there's the normal sway of developments internationally. US data, the Chinese economy is hugely relevant for New Zealand. Europe's economic malaise, will be starting to see further stabilisation. Closer to home, we look at the Australian economy. It does look like the Reserve Bank of Australia is going to be cutting rates at some stage in the next couple of months. They're hugely relevant. But I guess if you look at what's going to be going on locally, probably the biggest development we'll be looking at will be the implementation of loan-to-value ratio restrictions. The Reserve Bank's got a fair head of steam up behind the scenes in regard to these. The Auckland property market's been surging ahead. House prices up about 20% in a year. That's unsustainable. Lifting the official cash rate, I don't think is the right policy instrument to be deploying at this juncture of the economic cycle. That's tomorrow's story as opposed to today's. At this juncture, it looks like the Reserve Bank is going to turn to what's called prudential policy. We're just waiting for finer details on what the nature and extent of those limits are likely to be. And then, of course, we'll look at some assessment in terms of what the consequences are for the property market over the next 3 to 4 months. The more bang for the buck the Reserve Bank gets with the implementation of those prudential policy measures, the less pressure there will be for them in terms of their primary policy instrument, the official cash rate.
Also, what sort of performance are we seeing from New Zealand government bonds?
Well, they've been another example of the two-bit player at the international roulette table. So, US 10-year treasuries, that market's been a global bellwether for all bond markets internationally. You've seen that big sell-off as the US Federal Reserve has flagged that quantitative easing is going to progressively start to come to an end at some stage in the next 12 to 18 months. That's flowed through to the New Zealand bond market. So you've seen longer New Zealand 10-year bond yields have moved up about 80 points in the past 2 to 3 months. From a relative basis, I still think New Zealand government bonds offer pretty attractive value at these sort of levels. You've got an improving economy. You've got a very clear, credible fiscal consolidation strategy coming out of the government. And in fact, if I have a look at the fiscal prowess the New Zealand government is showing relative to a lot of international peers, I'd call them unrivaled.
Thank you very much, Cameron, for that. Well, viewers, do stay tuned to Dukascopy TV for more press reviews and updates. But for now, goodbye.